Hello and welcome to Business Today. I'm Siddharth Zarabi and you're watching Easynomics. On the show today with me is Sonal Varma, Managing Director and Chief Economist, India and Asia ex-Japan at Nomura. Welcome to the show, Sonal, and very interesting time to be having this chat with you because the United States has indicated that a trade deal with India is likely to be the first amongst many that the United States hopes to sign, uh, possibly on favorable terms for itself. What do you make of the comments of the US Treasury Secretary, and do you think this is a significant point as far as a new trade pact with the United States is concerned for India?
Yeah, hi Siddharth. Thanks for having me. So I think India, alongside South Korea and Japan, do seem to be the front runner in terms of negotiating the trade deals. And specifically for India, our negotiations started early on. The terms of reference have already been finalized. So essentially, we are now negotiating the terms on which things will be negotiated. Now, typically, trade agreement and negotiations take a lot of time. There's negotiation on agriculture, market access, tariff, non-tariff barriers, rules of origin. A lot of these things will take time to iron out all the details, but some form of an early tranche or let's say a memorandum of understanding of the terms on which things will be get negotiated, at least that can be signed off fairly quickly. So definitely a front runner and a positive for India there.
Sonal, we still sort of don't have the details of what is being discussed, but from a impact point of view, post a first phase or a early harvest kind of deal, what is your sense, if at all, on the average tariffs that India will have to bear for exports to the United States? Because currently the level is 10%. Do you see a significant change in that?
So this 10%, as you know, is during the 90-day pause. The original reciprocal tariff that was imposed was much higher at 26%. Now, if we can negotiate, things down, then the reciprocal tariff rate could come down. It could come down to 10%, could be somewhere between 10 or 26%. But the progress on the trade deal does suggest that the tariff rate will get negotiated down. I think it'll be hard for the tariff rate to come down below 10% because that seems to be the minimum that the US is imposing on a number of countries, and this is their sort of avenue to raise revenues as well on the fiscal side. So it's likely to be at least 10%, even if it is brought down from 26. Now, this itself is quite important because if we can negotiate the tariff rate down, then we can still have a relative tariff advantage compared to some of our competitor countries. So the negotiations are important, partly in that context.
Sonal, let's go with this scenario that we are discussing, which is part one, early phase one kind of deal before the 90-day deadline ends. Second, assuming 10%. If that is the assumption, what is your sense about the impact for India's growth in the current fiscal year?
Yeah, so for the current fiscal year FY26, baseline growth projection is 5.8% on GDP. The direct impact from US tariffs on our estimate is between 0.2 to 0.3% of GDP, which is low in a relative sense because for a number of Asian countries, the economic hit is anywhere between zero point 0.5 to 1 percentage point. So India is relatively better off. That said, I think more than the direct impact, there are multiple indirect effects actually that we need to consider. India, the US tariffs is going to have a negative knock-on effect on world GDP growth, which will impact India in turn. Uncertainty is weighing on business confidence and business investment, and we think private investments will get delayed even further. And demand in sectors like IT, particularly on the discretionary side, could be impacted. And as you know, that's an important driver of job creation in India. So there can also be some spillover effect on the urban consumption side because of this tariff and uncertainty. So relatively better off compared to other countries in Asia, but there would still be a negative impact in FY26.
Could falling crude oil prices be the silver lining in what seems to be a bit of a dark cloud, really, Sonal?
Yeah, absolutely. I mean, as a net oil importer, lower oil prices tend to be what we call a positive terms of trade shock for India. It is going to bring down the cost of input for manufacturers. It's going to bring down inflation, and that's positive for real income for consumers. And we've seen, and of course, it's going to bring down the oil import bill more generally, which is a positive on the current account. And what we have seen is that the government has used the first round of lower global oil price to actually hike excise duty on fuel. So they are trying to create a fiscal buffer and prevent any kind of fiscal slip from happening because of weaker tax revenue. So on net, yes, lower oil price is a silver lining in an otherwise negative drag that will be there from other channels.
Uh, let's turn the focus on the government's overall macroeconomic management. You made this very important point about how it responded to the crude oil price fall. What do you expect to be the main drivers of fiscal policy in at least in the next couple of quarters, really?
I mean, I think for India, the fiscal space is limited. And we do think that between fiscal and monetary policy, the monetary policy side is the one that's going to do more of the heavy lifting. What is important, though, from the fiscal side is number one, to ensure that we spend money on time. This was a lesson from FY25, where because of elections, the delay in government spending did have a negative impact on GDP growth. We cannot afford that. So right from the start in FY26, we need to ensure that spending is on time at the center level. Money is dispersed to states, and that states spend that money. So I think that is most important. And second, the current trade tensions and shock impact the exporting sector more specifically. And within the export sector, sectors like gem and jewelry, for instance, are more negatively impacted. A lot of the exporters are small and medium enterprises, and some of them could face cash flow problem. So if there's some sort of a fiscal support, or it could be support in the form of credit availability via the banking system, but a mix of either an interest rate subvention or credit support to the sectors that are heavily hit because of weaker global demand, that more targeted fiscal support could be done. I think that's the priority at this stage. One thing which will become more clear after September is to what extent could we face potential tax revenue shortfall because of weaker nominal GDP growth. And the two buffers that the government has, one is the excise hike on fuels, and second, potentially, and we'll have clarity on this in May, is whether the RBI disburses more dividend to the government. So this can be used to offset any revenue slip that happens. But I think spending money on time and more targeted support for exporting sectors, either through fiscal or via the banking system, I think that should be a priority.
One point on trade further before I come to the RBI bit. We have had this discussion before after COVID, China plus one, and now again this debate around the supply chain shifting to India. Should we be more hopeful of that happening in a more impactful manner this time around?
Well, I think the US strategy appears to be a strategic decoupling from China. Now, this did not happen exactly in the first Trump administration, because while China's exports to US did fall, there was a rerouting of those exports via Southeast Asia and Mexico. So this time around, not only has the US imposed higher tariffs on China, there's also higher tariff on some of the Southeast Asian countries that were used to bypass the China tariffs on US. So this strategic decoupling from China, which is the US objective, is an opportunity for India. China is, a major player in various manufacturing segments. For instance, in toys, China's global market share is almost 60% of world toy exports comes from China. It's 35 to 40% in the case of electronics, in the case of textiles, and India's market share is fairly low. So if we have a relative tariff advantage, if companies are looking to de-risk from China, and if we have the right domestic business environment, then yes, we can actually see our market share increase. We've seen this in the case of smartphones, but we can also see this replicate in what we call the low-tech and mid-tech manufacturing space, which includes things within electronics, outside smartphone, for instance, in the PC, in the personal computer space, in textiles, toys. These are just some examples where India can increase its global export market share because of both the global push factor, but I think importantly, the domestic pull factor in terms of ease of doing business and the big domestic consumer market that India offers and can offer to these MNCs.
What should we be expecting the Reserve Bank of India to do? As our viewers know, there's been a change of guard at the Reserve Bank of India, and that led to a certain set of actions, plus this challenge that has been posed by the United States and its reciprocal tariffs. Soft growth, inflation backdrop, and you believe that there are likely going to be significant cuts. Explain that to our viewers.
Yeah, the path for the RBI is fairly clear, and there aren't per se any major policy trade-offs. So for FY26, RBI's projection for growth is at 6.5. We think growth will end up being below 6% next year, which in the ongoing financial year, which means that growth will be below trend. And at a time when export demand is soft, global demand is soft, we need counter-cyclical policies in order to support domestic demand. And, as I mentioned earlier, between monetary and fiscal policy, we think monetary policy has the room. Second, inflation is very well aligned with the RBI's target of 4% midpoint. In fact, for most of the next 2-3 quarters, we think headline inflation will actually average below the 4% target. So we are very well aligned to the target. And third, this is the outlook on currency. This is generally not been a major hurdle for India, but we are also seeing dollar weaken or appreciation pressure on the currency, which means that typically when, for many emerging markets, currency tends to be a hurdle for central banks to cut rates, but that hurdle is also not there. Oil prices are down. So I think all, put together on the macro side, there is a room as well as a need to cut rates. So we are still at, for instance, real rates in India are high. at 6% repo rate and average inflation of 4% over the next 12 months. Real policy rates are at 2 percentage points, which is more in the restrictive territory. In our view, there is room for another 100 basis point more in rate cuts to bring down the repo rate to 5% by the end of this year.
Is there any further expectation of moves, any more moves on the liquidity front by the central bank?
I mean, that's one toolkit that RBI has already used fairly aggressively, and they have front-loaded liquidity easing, and rightly so. The objective here really is to fast-track policy transmission. Typically, the transmission from RBI's rate cuts to banks transmitting it to final lenders takes time. And that transmission can, I mean, while the part of the lending book which is directly linked to the repo rate will immediately reprice lower, it takes time for the deposit cost to come down. So the entire book takes time to reprice lower. So the clear messaging from the RBI in terms of accommodative stance and the very aggressive liquidity easing measures we are seeing right now, the commitment to keep liquidity closer to 1% of net demand and time liabilities, or around 2.5 trillion in surplus, and following it up with action sends a very clear signal to banks and should enable faster transmission. So should we expect this to continue? The answer is yes. Through various tools, the open market operations, RBI has also been using other tools like FX buy-sell swap, longer-term variable rate repo operations. These are various tools that are available for the RBI to inject durable liquidity. And we think liquidity easing will continue, will be kept in a decent surplus in order to accelerate policy transmission for the banking sector as well as for the financial markets more broadly.
Sonal, just to switch gears a little bit towards the global situation, you know, this 90-day period and perhaps 180 trade deals that need to be done, the big one being China, and we have seen lots of back and forth in the commentary from the United States. But the question I have for you, are you and your colleagues at all even discussing the possibility of an extension of this 90-day period? And if so, will that prove to be a far more rosier scenario than that is being envisaged right now for American growth and the global economy?
I mean, all options are on the table. It's clearly difficult to negotiate with all countries within such a short time period. But whether indeed there will be an extension or not, I think it's very hard for anyone to take a call on that. So it's possible. We don't know. Our own assumption is, for instance, the 145% tariffs on China will likely get lowered because at these levels rates are way too high. It's almost a trade embargo. But they will likely be brought down to about 60%, still higher than the tariff on most countries. So in terms of the economic impact, if there is, let's say, another extension, I mean, it'll bring a bit of a relief, I guess, for exporters and for countries that are trying to negotiate the deal. But it also is just prolonging uncertainty, right? I mean, I think it's very hard for businesses to make any decision on whether to hire workers, whether to build new factories, when you have just so much uncertainty on where things will finally settle down. So we think, to an extent, the damage is already done. And the weakness in global demand, the impact on China's retaliation, and many countries export to China, and you have China then exporting to the U.S. So if tariffs stay high on China, that will still have a knock-on effect on many countries around the world. And as we were discussing, there's the impact on uncertainty on investment, on job creation, on income growth, etc. So we are fairly comfortable with the view that US growth and world growth is going to slow this year. Our prediction for US growth by the end of this year on a quarter-on-quarter annualized rate basis is around 0.5%. So, nearly zero. We're not calling for a recession, but it's a close call. But my point simply is that, extending is possible, but the damage is done.
That's a very good point. And many people in the markets are looking at different scenarios. But if you see trade related data, shipping data, it seems to point towards quite a scary picture in the current quarter. And you're absolutely right. Another 90-day extension may just add to the uncertainty and keep every plan on hold. Winding down this conversation, I want your comment and thoughts about what it means for the India market. Nomura Global Markets Research Viewers has set a Nifty 50 target for March 2026 at 24,970, which is almost a 3.5% increase from current levels. The December end target was 23,784, which was given earlier. So just your sense, what can we expect as far as earnings are concerned and in India?
Yeah, so our India equity strategy team, in terms of the outlook on the earnings side, they do think there is some scope for further downgrade in earnings for FY26 relative to where consensus is right now. And the macro picture is a bit of a mixed bag with the export-oriented sectors still facing a lot of the headwinds that we discussed, the investment side being relatively soft. In this environment, we think domestic consumption should be relatively more of a buffer compared to the more export-oriented sectors, but we do see some downside to earning consensus expectations from here.
One final question, Sonal, and I'm switching back to the macro. What's your sense about how inflation and industrial growth is likely to pan out? Because some data suggests that even the last quarter of that is January, February, March, government spending was perhaps not up to expectations, including, for example, in the highways and road construction space. So therefore, what's your sense overall from both a price stability point of view and industrial growth?
Price stability, I think, should be there. And most of the drivers of inflation seem to be favorable. So, for instance, the outlook on, the Rabi production that's coming out seems to be positive. There is a risk around heat wave, but typically it impacts perishable items for a temporary period of time. I don't think it's going to be like a persistent headache on inflation. And the outlook for the monsoon season this year is positive. Commodity prices have come down. Output gap is negative. The wage growth, which is an important driver of services inflation, also is in check. So both the global and domestic demand supply environment seem to suggest we are moving towards price stability, and we do think inflation is very well aligned to the 4% target. The only risk to watch would be any food-related fluctuations. So that's not a major concern. Now, the industrial production growth is going to be a bit of a mixed bag because the consumer side, the non-durable production should be positive. Rural demand, monsoons, we think will be positive. But on the consumer durable side, which is more sensitive to discretionary demand, there is a risk because we've seen a slowdown in consumer credit growth. There is a slowdown in job creation. Income growth is slowing down in terms of salary increases, for instance. And all of these factors have an impact on discretionary demand. Plus, the export demand has mixed impact across sectors. While we are seeing India benefit from trade diversion and improvement in exports of products like electronics, there are other segments like gem and jewelry, for instance, where export demand will be adversely impacted. Similarly, on the investment side, government-driven Capex construction should be steady in FY26. But private investment related activity, we think, will be on the softer side. So it's a mixed bag. On the whole, we're expecting industrial growth to remain in low single digit, so more lackluster. And relative to investment, we think the consumer on the non-durable, the rural side, should be a better performer in FY26.
All right, Sonal, you've given us a very nice overview of what I would describe as the volatile and uncertain economic environment that we live in. There are lots of, good bright spots, but there is quite a bit of dark as well. But perhaps the biggest headline, viewers, at this stage, at least from a sentiment point of view, is the trade talks between India and the United States, and the hope expressed by the United States that India will be amongst the first few countries with which a trade deal, and that could help us sort out some uncertainty on that front. Sonal Varma, as always, thank you very much for your time with us and for sharing with us your insights into what is clearly quite a complex situation. Viewers, with that, we are wrapping up the show. We'll come back with more continuing coverage. Do stay tuned in. I'll see you soon. Bye-bye.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the earnings special conversation. Our focus will be on PNB Housing Finance that's reported its stellar numbers and the stock